So you've got $10,000 sitting there and you're wondering what to do with it. Maybe you saved it up over the past year. Maybe you got a bonus. Maybe you finally built up that emergency fund and now you've got extra cash burning a hole in your pocket. Whatever the case, you're asking yourself the question that everyone with a little bit of money eventually asks: how do I make this work for me? Here's the thing. $10,000 is a weird amount of money. It's not life-changing, but it's not nothing either. It's enough to matter, enough to grow into something significant over time, but it's also small enough that you could blow it on something stupid and spend the next 5 years regretting it. So the pressure you're feeling right now, that's actually healthy. It means you understand that this money represents something: your time, your effort, your discipline. But let me tell you what I see happening all the time. People get so paralyzed by the options that they do nothing. They leave that 10 grand sitting in a savings account earning 2% while inflation eats away at their purchasing power. Or worse, they panic and throw it into whatever meme stock or cryptocurrency their cousin mentioned at Thanksgiving dinner. Both of these approaches are terrible, and I want to help you avoid them. What we're going to do together is build a framework, not a prescriptive do exactly this list, because honestly, your situation is different from mine, which is different from your neighbor's. What I'm going to give you is a way of thinking about your money that will serve you not just with this $10,000, but with every financial decision you make for the rest of your life. Sound good? Let's get into it. Before we talk about where to put your money, we need to establish some ground rules. Think of these as prerequisites, boxes you need to check before you even consider investing a single dollar. If you haven't done these things, stop worrying about investment strategies and handle these first. Number one, you need an emergency fund. This is non-negotiable. I'm talking about 3 to 6 months of essential living expenses sitting in a high-yield savings account where you can access it immediately. Why? Because life happens. Cars break down, people get laid off, medical emergencies show up uninvited. If you don't have this cushion, any money you invest is money you might need to pull out at the worst possible time, like during a market crash when your investments are down 30%. Number two, no high-interest debt. If you're carrying credit card balances at 18, 20, 25% interest, paying those off is your investment strategy. There is no guaranteed investment that will beat the return you get from eliminating 20% interest debt. None. So if you've got $10,000 and $6,000 in credit card debt, congratulations. You've got $4,000 to invest and a guaranteed 18% return waiting for you. Number three, you're investing for the long term. If you need this money in the next 2 years for a down payment on a house or some other major expense, it probably shouldn't be in the stock market. Market volatility is real, and a 20% drop right before you need your cash is a very real possibility. Money you need soon should stay in high-yield savings or short-term treasury bills. Now, assuming you've got those bases covered, let's talk about what's actually happening in the world right now, because context matters enormously when making investment decisions. We're sitting here in 2026, and the economic landscape is genuinely fascinating. The Federal Reserve has been threading a needle for the past couple of years, trying to bring inflation back down without triggering a recession. As of right now, we're seeing interest rates that are still elevated by historical standards but starting to stabilize. The labor market has cooled from its post-pandemic highs but remains resilient. Corporate earnings have held up better than many analysts predicted. But here's what's interesting. We're also seeing some structural shifts that are going to shape investing for the next decade. Artificial intelligence isn't just a buzzword anymore. It's fundamentally changing how businesses operate, how productivity is measured, and which companies are positioned to capture value. We're seeing reshoring of manufacturing, driven by both geopolitical concerns and new industrial policy. Green energy infrastructure is being built out at an unprecedented pace. Demographics are shifting as baby boomers retire and younger generations enter their peak earning years. What does all this mean for you and your $10,000? It means we're investing in a period of transition. And transitions, while uncertain, often create the best opportunities for patient investors who understand what's happening. Let me give you some concrete numbers to anchor this discussion. The average annual return of the S&P 500 over the past century is roughly 10%, or about 7% after inflation. That's your baseline. what you can reasonably expect from a diversified portfolio of American stocks over long periods, but averages hide a lot of volatility. In any given year, the market might be up 25% or down 20%. The 2022 bear market reminded everyone that stocks don't just go up, but over 10, 20, 30-year horizons, that long-term average has been remarkably consistent. So let's say you invest your $10,000 and earn that historical average of 10% annually. In 10 years, you've got roughly $26,000. In 20 years, $67,000. In 30 years, over $170,000. That's the power of compound growth. Einstein allegedly called it the eighth wonder of the world. And whether he actually said that or not, the math is undeniably impressive. Now let me walk you through a framework for thinking about how to actually allocate this money. I'm going to present this as a series of questions you should ask yourself because the right answers depend entirely on your personal situation. First question, what's your time horizon? This is probably the single most important variable in determining your asset allocation. If you're 25 years old and this money is for retirement, you have 4 decades of compound growth ahead of you. You can afford to be aggressive, ride out market downturns, and focus almost entirely on growth. If you're 55 and planning to retire in 10 years, you need to think more carefully about protecting what you have while still growing it. For long-time horizons of 15 years or more, historical data strongly supports a heavy allocation to equities, stocks. The longer you hold them, the more the volatility gets smoothed out and the more reliably you capture those long-term returns. Second question, what's your risk tolerance? And I don't mean what you think your risk tolerance is right now, while markets are calm and your portfolio is just numbers on a screen. I mean, what's your actual tolerance for seeing your balance drop by 30 or 40% during a bear market? Because if you panic and sell at the bottom, all your clever asset allocation means nothing. Be honest with yourself here. If watching your $10,000 become $7,000 would cause you to lose sleep and make emotional decisions, you might want a more conservative allocation than pure optimization would suggest. The best portfolio is one you'll actually stick with. Third question, what's your current financial situation? Do you have a stable job? Is your income likely to grow? Do you have other investments? Or is this your entire portfolio? If this $10,000 represents everything you have outside your emergency fund, diversification becomes even more important. If it's a small piece of a larger portfolio, you might have more flexibility to take concentrated bets. Now let me give you some concrete allocation strategies based on different situations. If you're young, have a long time horizon, stable employment, and genuine tolerance for volatility, here's what I'd consider. Put the vast majority, say 80 to 90%, into a total stock market index fund, something that tracks the entire U.S. market, like a total market ETF. This gives you exposure to thousands of companies with a single purchase, minimal fees, and built-in diversification. With the remaining 10 to 20%, you could add some international exposure through an international stock fund, which gives you diversification beyond the American economy. Why index funds? Because the data is overwhelming. The vast majority of actively managed funds underperform their benchmark indexes over long periods, especially after accounting for fees. You're not trying to beat the market. You're trying to be the market. And over time, the market has been a remarkably effective wealth-building machine. If you're more moderate in your approach, maybe you're in your 40s or 50s, or you just have lower risk tolerance, consider something like a 60-40 split. 60% in stock index funds and 40% in bond index funds. Bonds provide stability and income, dampening the volatility of your portfolio while still capturing some growth. This classic allocation has worked well for decades, though it's worth noting that bonds don't always provide the same diversification benefits they once did, especially in inflationary environments. If you want to get slightly more sophisticated, here's a framework I find useful. Think of your portfolio in 3 buckets. Bucket 1 is your foundation. This is 70 to 80% of your money, and it goes into boring, diversified, low-cost index funds. Total U.S. stock market, total international stock market, maybe some bonds depending on your age and risk tolerance. This is the stuff you buy and basically never sell. It just sits there, compounding, year after year. Bucket 2 is your satellite holdings. This is maybe 15 to 20%, and it's where you can take slightly more concentrated positions based on your views about the economy or specific sectors. Maybe you believe strongly in the AI transformation and want extra exposure to technology. Maybe you think clean energy is undervalued. Maybe you want some real estate exposure through REITs. This is where you can express specific investment theses while still keeping the core of your portfolio boring and diversified. Bucket 3 is your speculation money. And I want to be clear. This should be 0 to 5% maximum. This is the money you're genuinely prepared to lose. Maybe it's individual stocks you find interesting. Maybe it's a small cryptocurrency position. Maybe it's that startup your friend is launching. Whatever it is, you should think of this money as tuition. You're paying to learn, to stay engaged with markets, to scratch that gambling itch that everyone has. But if you lose it all, your financial future shouldn't be affected. Let me give you a specific example of how this might work. Say you're 30 years old with $10,000 to invest, a stable job, an emergency fund already in place, and no high-interest debt. Here's one reasonable approach. You put $7,000 into a total U.S. stock market ETF. That's your foundation. Boring, diversified, lowest possible fees. You never touch it. You put $2,000 into a growth-oriented position. Maybe it's a technology-focused ETF that gives you extra exposure to the AI boom. Maybe it's an international fund focused on emerging markets because you think developing economies will outperform over the next decade. You're taking a view here, but it's still a diversified bet. You put $1,000 into something speculative. Maybe you've done research on a specific company and believe in its long-term potential. Maybe you want some cryptocurrency exposure because you think digital assets are here to stay. Whatever it is, you accept that this money might go to zero, and you're okay with that. That's a framework. Not the only framework, not even necessarily the best one for your specific situation, but a reasonable starting point that balances growth potential with risk management. Now let me address some scenarios and risks you should be thinking about. Scenario 1. We get a recession. Look, recessions happen. They're a normal part of economic cycles, and trying to time them is a fool's errand. If a recession hits and stocks drop 30%, your $10,000 becomes $7,000 on paper. This is where emotional discipline becomes essential. Historically, the worst thing you can do is sell during a downturn. You lock in your losses and miss the recovery. If you're investing for the long term, downturns are actually opportunities to buy more at lower prices. Scenario 2. Inflation stays elevated. This has been a major concern over the past few years, and it's worth considering. Inflation erodes the purchasing power of cash and hurts fixed income investments like bonds. Stocks, however, have historically been a reasonable inflation hedge over long periods because companies can raise prices and grow earnings alongside inflation. This is another argument for maintaining significant equity exposure. Scenario 3. Interest rates move significantly. If rates rise further, it tends to hurt stock valuations in the short term, particularly for growth stocks. If rates fall, it tends to benefit stocks, but reduces returns on savings accounts and bonds. Rather than trying to predict where rates are going, the better approach is usually to have a diversified portfolio that can weather various environments. Scenario 4. Geopolitical disruption. Wars, trade conflicts, pandemics. These are impossible to predict, but very real risks. Geographic diversification helps here. If your entire portfolio is in U.S. stocks and something terrible happens to the American economy specifically, international exposure provides some buffer. This doesn't mean you need to go overboard. The U.S. economy is still the largest and most dynamic in the world, but having 10 to 20% in international stocks is reasonable insurance. Now, I want to talk about the practical mechanics of actually getting this done, because strategy is worthless without execution. Step 1. Open a brokerage account if you don't have one. There are many excellent options with zero commissions on stock and ETF trades. The interface should be intuitive, the mobile app should work well, and customer service should be accessible when you need it. If you're investing in a tax-advantaged account, like an IRA, make sure your brokerage offers that option. Step 2. Decide between taxable brokerage account and retirement accounts. If you have access to a 401k with an employer match, that match is free money. Prioritize getting the full match before doing anything else. If you've maxed out your 401k match or don't have access to one, consider a Roth IRA. Your contributions grow tax-free, and qualified withdrawals in retirement are also tax-free. The 2026 contribution limit is something you should verify, but for most people, maxing out a Roth should be a priority. Only after you've used tax-advantaged space should you invest in a regular taxable brokerage account. Step 3. Set up automatic investments. This is crucial. Once you've decided on your allocation and purchased your initial positions, set up automatic monthly contributions. Even if it's just $100 or $200 a month, the habit of consistent investing is more important than the specific amount. This is dollar cost averaging in action. You buy more shares when prices are low and fewer when prices are high, smoothing out your entry points over time. Step 4. Rebalance periodically. Over time, different parts of your portfolio will grow at different rates, throwing off your target allocation. Once a year, check whether your actual allocation matches your target and rebalance if needed. This forces you to sell some of what's done well and buy more of what's lagged, essentially buying low and selling high automatically. Step 5. Keep learning but avoid overtrading. Read about investing, follow market news if you find it interesting, and continue educating yourself. But resist the urge to constantly tinker with your portfolio. Every trade has costs, if not commissions, then potential tax consequences and the psychological toll of second-guessing yourself. The evidence strongly suggests that less frequent trading leads to better outcomes for most investors. Let me share a few mindset principles that will serve you well over the long term. First, focus on what you can control. You can't control market returns, economic conditions, or geopolitical events. You can control your savings rate, your asset allocation, your costs, and your behavior. Pour your energy into those things. Second, time in the market beats timing the market. Study after study shows that missing just a handful of the best trading days over a decade dramatically reduces your returns. The best days often come right after the worst days when fear is highest. If you're out of the market, you miss them. Stay invested. Third, avoid lifestyle creep. As your investments grow and your income increases, resist the temptation to dramatically increase your spending. The person who makes $100,000 and invests 20% of it will build wealth faster than the person who makes $200,000 and spends it all. Your savings rate matters more than your return rate, especially early in your investing journey. Fourth, think in decades, not days. Checking your portfolio daily is a recipe for anxiety and poor decisions. Weekly is probably fine. Monthly is even better for most people. The more often you look, the more volatility you see, and the more tempted you are to react emotionally. Zoom out. Fifth, understand that fear and greed are your enemies. When markets are crashing, everything inside you will scream to sell. When markets are soaring and your neighbor is bragging about their gains, everything will push you to go all in at the top. Recognizing these emotional pulls is the first step to resisting them. Have a plan, write it down, and stick to it regardless of what the market is doing. Let me address a few common questions I hear from people in your situation. What about real estate? Real estate can be a great investment, but $10,000 isn't enough to buy property in most markets. You could consider REITs, real estate investment trusts, which let you invest in real estate through publicly traded securities. These belong in your satellite holdings if you want real estate exposure. But don't feel like you need real estate to build wealth. Plenty of people become millionaires through stock market investing alone. What about cryptocurrency? Cryptocurrency is highly speculative. It might revolutionize finance, or it might collapse. No one knows for certain. If you want exposure, keep it small, 5% or less of your portfolio, and only invest what you can afford to lose entirely. Never let speculation derail your core investment strategy. What about individual stocks? If you enjoy researching companies and have genuine conviction about specific businesses, individual stocks can be part of your satellite holdings. But understand that you're competing against professional investors with vastly more resources and information. Most people are better served by sticking primarily to index funds. Should I use a financial advisor? For most people with $10,000, a financial advisor isn't necessary. The strategies we've discussed are straightforward enough to implement yourself, and advisor fees, even for fee-only advisors, can eat significantly into your returns at this portfolio size. If your situation is complex or you genuinely won't take action without professional guidance, an advisor might be worth it. But be very careful about advisors who work on commission or recommend expensive products. Let me give you one final perspective. The fact that you're thinking carefully about what to do with this money puts you ahead of most people. Financial literacy is a superpower in modern life, and by taking the time to educate yourself, you're already making the most important investment of all, in your own knowledge and decision-making ability. $10,000 invested wisely won't make you rich overnight. But it's a start, it's a foundation, and more importantly, it's the development of habits and mindsets that will serve you as your income grows and your investment amounts increase. The person who thoughtfully invests $10,000 is the same person who will thoughtfully invest $100,000 or $1 million. So here's what I want you to do. Today, not next week, not next month, today, take one concrete step. Maybe it's checking that you have an adequate emergency fund. Maybe it's opening a brokerage account. Maybe it's actually purchasing that first index fund. The specifics matter less than breaking through the paralysis that keeps so many people stuck. You've got the knowledge now. You've got a framework. You understand the ground rules. You know the options. You're aware of the risks and how to mitigate them. The only thing left is action. Your future self will thank you. Start today.